Okay, so we're talking about proactive tax planning. It's not about avoiding tax. It's about making informed, lawful decisions early enough to improve cash flow, reduce risk, and support long-term growth. This includes not only planning for tax payments and compliance, but also choosing the right business structure from the outset. Whether a business operates as a sole prop, a partnership, company, CC, or a trust, it can significantly affect your tax obligations, your admin burden, and long-term flexibility. So proactive planning does matter, especially with the recent developments in South Africa, which have highlighted stronger enforcement and digital verification. We've seen that playing out with SARS, CIPC, and the banks, just to name a few. That means businesses and individuals need more than year-end compliance. They need a tax strategy that anticipates tax payments, uses available reliefs correctly, and keeps records ready for review. Proactive planning turns tax from a reactive burden into a managed business function. Practical areas that should be focused on include the choice whether you go for a sole prop, a partnership, a CC, a PDY, in other words, a private company, or a trust, has a direct impact on how profits are taxed, how owners benefit, and how much personal risk they carry. One needs to make full use of legitimate deductions, capital allowances, retirement fund contributions, and sector-specific incentives where applicable. For example, ensure your home office expenses have been accounted for legally, as well as asset depreciation, specifically vehicles, and finance charges for business mortgage bonds are all recorded. It's also worth mentioning that planning in advance for purchase of capital assets and the timing thereof is crucial. Assets are depreciated and written off over their useful lives, so rather buy it early in the year than later, so you get the full tax benefit for that particular tax year. And also key is to monitor turnover thresholds, invoice accuracy, input tax support, and the impact of VAT on pricing, contracts, and cash flow. It's crucial to also forecast taxable income early so that provisional tax payments are realistic and do not create unnecessary penalties or year-end surprises. Provisional tax being payable obviously in February and August each year. I know many clients like to receive a tax refund, but I often have to remind them that in order to get a refund, you actually had to have paid tax to start off with. And the only reason a refund would be payable is if provisional tax was paid in excess of what needed to be paid. And that, in my opinion, rather have the cash in your business bank account than in SARS bank account. So make sure you only pay what's really needed. Of course, there are factors that come into play, as provisional is not final, and last-minute deals and transactions and scenarios do play out, but don't pay more than you need to. Timing is crucial for the expenses, but also when it comes to income. If a large sale is taking place at the end of Feb, push it into March. It will mean the delay in paying the tax on that by 6 to 12 months. Similarly, if you're selling a fixed property, the OTP is dated 28 Feb, make it the 1st of March. That'll delay the CGT, capital gains, tax payable to SARS. And taxes are always payable to SARS based on the invoice transaction agreement date and not when the money actually changes hands.